Okay, so you want to own a gold mine. Not a jewelry store. Not a company that buys and sells gold. An actual gold mine. You picture giant dump trucks hauling out tons of rock every day. Workers in hard hats disappearing into tunnels. Bars of shiny gold stacked inside vaults. Every ounce worth thousands of dollars. Every day, another fortune pulled straight out of the earth. It sounds like one of the most profitable businesses on the planet. After all, gold has been valuable for thousands of years. Empires have fought wars over it. Kings built kingdoms with it. Entire economies once depended on it. So owning the place where gold comes from should be a license to print money, right? Not even close. Because the biggest surprise about owning a gold mine is that before you produce your very first ounce of gold, you might spend hundreds of millions of dollars and still discover that your mine isn't profitable. That's because in the mining business, finding gold and making money are two completely different things. And that difference has destroyed some of the largest mining companies in history. Before your mine earns a single dollar, you first have to answer one simple question. Is there actually enough gold underground? That sounds obvious. But here's the strange part. Just because someone discovers gold on a piece of land doesn't mean the land is worth mining. Imagine someone tells you there's $10 million worth of gold buried underneath your backyard. Congratulations. You're rich. Except you're probably not. Because what they forgot to mention is that digging up that gold might cost $20 million. In mining, gold has two prices. The price people pay for it, and the price it costs you to extract it. The second number is the one that decides whether you become a billionaire or go bankrupt, which is why every gold mine starts long before the first shovel ever touches the ground. It starts with exploration, and exploration is basically the business of spending millions of dollars looking for something that might not even exist. Geologists begin by studying satellite images, old geological maps, and rock formations that may have formed millions of years ago. Then they collect rock samples, soil samples, water samples, sometimes even tiny grains of dust. Every sample is analyzed for microscopic traces of gold. Most of the time, they find nothing. Mining companies can spend years searching thousands of acres without discovering anything valuable. Only after promising signs appear do they bring in drilling rigs. Now imagine drilling hundreds of holes, each one hundreds of feet deep, simply to pull out long cylinders of rock called core samples. Each hole can cost tens of thousands of dollars. Large exploration programs often drill hundreds of these holes before making any decision at all. By the end of exploration, companies may have already spent tens of millions of dollars without selling a single ounce of gold. And here's where things become even more interesting. Finding gold isn't enough. You also have to calculate how much gold is actually there. This sounds easy. Just measure it. Except you can't, because the gold is still buried underground. Instead, engineers create computer models using thousands of drilling results to estimate how much gold might exist beneath the surface. Notice that word, estimate. Mining companies don't know with complete certainty. They're making the best scientific prediction possible. Sometimes those predictions are accurate. Sometimes they're spectacularly wrong. And when they're wrong, entire companies disappear. Once the exploration is complete, the government steps in. Because you can't simply walk onto public land, start digging a giant hole, and keep whatever you find. Mining is one of the most heavily regulated industries in the world. Before construction begins, companies often spend years securing permits, environmental studies, water management plans, wildlife protection agreements, community consultations, safety approvals. In many countries, local communities and indigenous groups must also be consulted before a project receives approval. Even after spending millions discovering gold, there's still no guarantee the government will allow you to mine it. Some projects spend over a decade waiting for permits. Others are rejected entirely. Now imagine you've finally received every approval. Construction can begin. This is where the real money disappears. Forget the image of one person with a shovel. Modern gold mining looks more like building an entire city. You need roads capable of supporting trucks weighing hundreds of tons, power plants, fuel storage facilities, water pipelines, workshops, offices, medical clinics, explosive storage bunkers, processing plants, employee housing if the mine is located in a remote area. Then come the machines. A single ultra-class mining truck can cost several $1 million. The giant excavators loading those trucks can cost even more. Some mines operate dozens of these machines simultaneously, and they don't run on hope. They run on diesel. Lots of diesel. A large mining truck may burn hundreds of gallons of fuel every single day. Fuel alone becomes one of the biggest operating expenses throughout the mine's life. But surprisingly, the biggest cost isn't always the machinery. It's moving the rock. Here's the part almost nobody realizes. Gold isn't sitting underground in giant shiny nuggets waiting to be picked up. Most gold exists in incredibly tiny concentrations. In many modern mines, 1 ton of rock may contain only a few grams of gold. Think about that for a second. A single pickup truck can carry about 1 ton. Now imagine crushing that entire truckload of rock, only to recover enough gold to fit comfortably inside a teaspoon. That's the business. Mining companies aren't really digging for gold. They're moving mountains, hoping the tiny amount of gold hidden inside is worth more than the cost of moving everything else. And that's exactly why scale matters so much. Small operations rarely survive. Large operations spread their enormous fixed costs across millions of tons of rock. Every truck, every crusher, every conveyor belt, every employee, every gallon of fuel. The larger the operation, the lower the average cost of producing each ounce of gold. That's why some of the world's biggest gold mines process over 100,000 tons of rock every single day. By this point, you've spent hundreds of millions, sometimes over $1 billion. You still haven't sold a single ounce of gold. And here's the uncomfortable truth. Your mine could still fail, because owning a gold mine isn't really a bet on gold. It's a bet that the gold underground can be extracted, cheaper than someone else can extract theirs. That one idea explains almost everything about the mining industry. The companies that survive aren't always the ones that discover the most gold. They're often the ones that can produce it at the lowest cost. And that's where our story really begins. Because digging the rock is only the first step. Turning ordinary gray stone into billions of dollars worth of gold is an entirely different business. By now, you've spent hundreds of millions of dollars. You've bought the land, received government permits, built roads through the wilderness, purchased gigantic mining trucks, constructed an entire processing plant. Years have passed, and you still haven't earned a single dollar. Finally, the day arrives. The first truck filled with gold-bearing rock drives toward your processing plant. This is the moment every mining company waits for. But here's the first surprise. The truck isn't carrying gold. It's carrying rock. Lots and lots of ordinary-looking gray rock. If you walked past it, you'd never know it contained millions of dollars worth of precious metal. That's because gold is usually invisible to the naked eye. In many modern mines, the concentration is so small that every truckload looks exactly like every other truckload. The real challenge isn't finding the gold anymore. It's separating it from everything else. And that process is one of the most expensive parts of the entire business. The journey begins with crushing. Imagine dropping a family car into an industrial machine powerful enough to turn it into gravel. Now imagine doing that with thousands of tons of rock every hour. The giant crushers reduce massive boulders into fist-sized rocks. Then another machine crushes those rocks into small stones. Then giant rotating mills grind everything even further until it becomes a fine powder. By this stage, your expensive mining equipment has transformed solid mountains into something that almost resembles gray flour. And yet, you still don't have any gold. Now comes the chemistry. Depending on the type of mine, companies use different methods to recover the gold. One of the most common methods is called cyanide leaching. At first glance, the name sounds terrifying, and that's because cyanide is extremely dangerous. But in controlled industrial environments, it has one remarkable property. It dissolves gold. The powdered rock is mixed with water and carefully measured chemical solutions inside enormous processing tanks. Slowly, the gold separates from the surrounding rock and enters the liquid. The remaining crushed rock, called tailings, is pumped into specially designed storage facilities. Those tailings may look harmless, but they represent one of the biggest environmental responsibilities a mining company will ever have. If a tailings dam fails, entire rivers can become contaminated. Communities downstream can lose drinking water. Wildlife habitats can be damaged for decades. That's why modern mining companies spend enormous amounts of money designing, monitoring, and maintaining these facilities long after mining has stopped. Because in mining, your environmental responsibility doesn't end when the gold runs out. Sometimes, It lasts forever. Once the gold has been separated from the solution, another process begins. The dissolved gold is collected using activated carbon or electrochemical methods before being melted inside extremely hot furnaces. Finally, after months of drilling, years of construction, millions of tons of rock, and hundreds of millions of dollars in investment, you produce your very first gold bar. Except, it isn't actually pure gold. Most mines produce what's called a doré bar. It usually contains gold mixed with silver and small amounts of other metals. These bars are shipped to specialized refineries where they're purified into the nearly pure gold used by banks, jewelry manufacturers, and investors around the world. Only now, after years of work, does the mine finally receive its first payment. Which brings us to the question everyone wants answered. How much money does a gold mine actually make? The answer surprises most people. Because mining companies don't control the price of gold, unlike a clothing brand that can raise prices, or a software company that creates premium subscriptions. A gold mine sells a commodity, and commodities have one universal rule. The market decides the price. If gold is trading at $3,000 per ounce, every producer in the world receives roughly the same market price. Whether you're mining in Canada, Australia, South Africa, or Nevada, you can't simply decide to charge more. So if everyone sells gold at nearly the same price, how does one mine make billions while another goes bankrupt? The answer is cost. Mining executives obsess over one number above almost everything else. The cost of producing 1 ounce of gold. This includes nearly everything: fuel, electricity, explosives, employee wages, equipment maintenance, processing chemicals, transportation, environmental monitoring, and dozens of other expenses. If producing 1 ounce costs $1,400 and gold sells for $3,000, the difference becomes your operating margin. But here's where things become dangerous. Gold prices don't always stay high. History has shown that gold can experience long periods of falling prices. When that happens, high-cost mines suddenly become unprofitable. Imagine spending $2,200 to produce 1 ounce, only for gold prices to fall to $2,000. Every ounce you produce actually loses money. Now imagine producing hundreds of thousands of ounces every year. You're not losing thousands. You're losing hundreds of millions. That's why mining companies constantly search for ways to reduce costs. They automate equipment, improve drilling techniques, reduce fuel consumption, optimize truck routes, upgrade processing plants. Even increasing gold recovery by just 1 or 2% can generate millions of dollars in additional revenue over the life of a mine. Tiny improvements, massive financial impact. But here's another detail most people never think about. Gold mines don't produce the same amount forever. The richest parts of the deposit are often mined first. Over time, the remaining rock usually contains less gold. This is known as declining or grade. Imagine your first year averages 4 grams of gold per ton. 5 years later, you're processing rock containing only 2 grams. You're moving the same amount of rock, burning the same fuel, paying the same employees, but recovering only half as much gold. Your costs quietly rise, even though nothing about your operation appears to have changed. This is one of the biggest reasons successful mines eventually close. Not because they completely run out of gold, but because the remaining gold becomes too expensive to recover. And then there's another risk, one that has nothing to do with geology. Politics. Gold mines cannot be moved. Once billions of dollars are invested, the mine stays exactly where it is. Governments know this. Sometimes taxes increase. Royalties rise. Environmental regulations become stricter. Export restrictions appear. In some countries, entire mines have even been nationalized. Imagine investing billions into a project that takes 10 years to build, only for a new government to change the rules overnight. That's a risk unique to industries tied permanently to the land beneath them, which is why the largest mining companies spread their operations across multiple countries. If one project encounters problems, the others continue producing, because putting everything into one mine is often considered one of the riskiest bets in the industry. And yet, despite all these risks, companies continue investing billions into new gold mines every single year. Why? Because when everything goes right, a world-class gold mine can generate billions of dollars over its lifetime. By now, your mine is finally producing gold. Every day, hundreds of trucks move across the site, The processing plant runs 24 hours a day. Gold bars leave the refinery every week. On paper, everything looks like a success. But here's the strange thing about the mining business. A gold mine can be producing millions of dollars worth of gold every single day and still be losing money. Because in mining, today's profits often belong to yesterday's investments. The machinery you're using didn't come cheap. Remember those giant haul trucks? Each one cost several $1,000,000. The excavators, the crushers, the processing plant, the roads, the employee housing. Most of it wasn't paid for in cash. It was financed, which means every month, before shareholders receive a single dollar, the banks get paid first. And those loan payments don't care whether gold prices are high or low. They're due anyway. That's why mining executives pay attention to something called the break-even price. This is the minimum gold price needed for the mine to survive. If gold trades above that level, the mine makes money. If it falls below, every ounce produced pushes the company deeper into the red. Here's where things become fascinating. Gold itself doesn't become cheaper to mine overnight. The rocks don't suddenly contain less gold. The trucks don't instantly consume more diesel. What changes is the market's willingness to pay for the metal. And because no mining company controls the global price of gold, every producer is playing the same game. Some simply play it better than others. That's why low-cost mines become incredibly valuable during difficult years. When weaker competitors are shutting down, efficient mines continue operating. In fact, some mining companies secretly hope for lower gold prices. Not because they enjoy making less money, but because falling prices force inefficient competitors out of business. When supply eventually falls, gold prices often recover. The survivors are left with an even larger share of the market. It's a brutal cycle, and it repeats itself over and over again. But perhaps the biggest misconception about owning a gold mine is this. People think the goal is to mine forever. It isn't. Every gold mine has an expiration date. Unlike a factory, a shopping mall, or a hotel, a gold mine is slowly destroying the very asset it depends on. Every ounce you sell is 1 ounce you'll never sell again. Imagine owning a warehouse with 1 million gold coins inside. Every customer who buys a coin makes you richer today, but your inventory keeps shrinking forever. That's exactly what a gold mine is. It's a business designed to run out of business. And that's why mining companies are always searching for the next discovery, even while their current mines are making billions. Because if they stop exploring today, they may have nothing left to mine tomorrow. Now let's look at one company that understood this better than almost anyone. Barrick Gold. Over the past several decades, Barrick has built some of the largest gold mines in the world. But here's what's interesting. Barrick didn't become one of the world's largest mining companies simply by finding the biggest gold deposits. It became successful by buying mines, selling mines, expanding efficient operations, closing expensive ones, and constantly managing risk. In other words, Barrick isn't just in the gold business. It's in the capital allocation business. Because sometimes the smartest decision isn't opening a mine. It's walking away from one. Mining history is full of companies that ignored this lesson. Some borrowed billions of dollars when gold prices were high, assuming prices would stay high forever. Then the market turned. Revenue collapsed. Debt remained. Projects were canceled. Workers were laid off. Entire companies disappeared. Not because there wasn't gold underground, but because the economics no longer worked. That's an important distinction. A mine doesn't fail because it runs out of gold. It fails because it runs out of profitable gold. Then there's something almost nobody thinks about. Closing the mine. Most businesses celebrate their final day with retirement parties. Mining companies prepare for decades of cleanup. When the last ounce of gold is produced, the work isn't finished. It's only changing. Open pits may need to be stabilized. Waste rock must be secured. Tailings dams require long-term monitoring. Water quality must be tested for years, sometimes for decades. Many governments now require mining companies to set aside hundreds of millions of dollars before mining even begins, simply to guarantee they'll have enough money to restore the land afterward. Think about that. Before you earn your first dollar, you're already planning for your last day in business. Very few industries operate that way. But despite all these costs, the regulations, the environmental responsibilities, the political risks, the debt, and the uncertainty, people continue investing billions into gold mining. Why? Because gold itself occupies a unique place in the global economy. People buy smartphones when they need technology. They buy oil when they need energy. But people buy gold for an entirely different reason. Trust. When economies become uncertain, when inflation rises, when financial markets panic, gold often becomes a safe place for investors to store wealth. That's why demand for gold doesn't come only from jewelry stores. It comes from central banks, investment funds, governments, and millions of ordinary investors around the world. Ironically, the worse people feel about the economy, the more attractive gold often becomes. That gives mining companies an unusual customer base. They're not just selling a metal, they're selling confidence. So, would owning a gold mine actually make you rich? Maybe. If you discover a world-class deposit, secure government approval, raise billions of dollars, build the infrastructure, control your operating costs, survive changes in gold prices, manage environmental risks, and know exactly when to expand or when to walk away, then yes, a single gold mine can generate billions of dollars over its lifetime. But that's also why there are so few successful ones. Because mining isn't really about digging gold out of the ground. It's about making thousands of correct decisions over decades. In one of the most capital-intensive industries on Earth, the gold underground is valuable. But the real asset isn't the metal. It's the ability to turn ordinary rock into profitable ounces, year after year, while everyone else is trying to do exactly the same thing. That's the economics of owning a gold mine. And that's why some holes in the ground become billion-dollar businesses, while others become billion-dollar mistakes.